So progressive exposure was one of the 3 huge breakthroughs that I finally stumbled upon that made a tremendous difference in my trading. It's so elemental and common sense and simple to a degree I can't believe I didn't do it for 15 years or so. Joe here, Joe's Investment Express. Let me tell you all about progressive exposure. First, let me tell you about 2 rookie traders. So, rookie trader number 1, he doesn't have a lot of money, and he makes a trade. He buys a stock for $1,000. It goes down. He sells it at a loss. That's frustrating and a little bit upsetting. So, he does a second trade at $1,500 because he's got to make up for the loss, right? Guess what? Stock starts to go down. He sells that one too. Well, now he's sitting on a fairly big loss. So his next trade, he does $3,000. Loses on that one. Now he's in a panic. He takes his whole account and he puts all 10 grand on a stock that his friend says is a can't miss. And he sees that the chart is pretty wild. So he decides not to use any kind of stop to let the stock go up and down. Well, you know what happens, right? He blows up his account. Here's rookie trader number 2. She's a little bit more experienced, a little more, she's experienced some success. And she always trades $1,000 blocks, no matter what. Or maybe she's a little bit wealthier or has built her account a little bit more, and she always trades $10,000 blocks. And she does well when times are good. But you know what? When the market is melting down like it has been this year, she is going to lose everything, right? Who are these rookie traders? Well, they were me, obviously, years ago. I made both of these mistakes, and I'm probably speaking to some of you too, right? So let's avoid these by using progressive exposure. And just remember, this is not investing advice. This is just education, just for entertainment, just what I do. And if I'm not making eye contact with you guys, it's because I'm looking at my notes over here. I want to make sure that I tell you everything I know. So let's get started. So here's what you got to understand. Investing is not black and white. It's not a light switch. It's not on or off. It's dynamic. Let's say the market is neutral. You're not in the market. You start a trade. You put on a trade for $1,000. If it does well, your next trade, 1.25. It does well, your next trade, 1.5. Then 2,000, then 3,000, and you're using the winnings, the gains that you made on the past trades to finance the increased risk on your larger trades. And you're not just throwing the money in any old time, but you're using precise entry points. But, well, that's for another video. I have some videos on that. So, and of course, then the reverse is true, right? You put on a trade for $1,000. It fails. Your next one is $750. It fails. Your next one, $250. It fails. You stop. You ask yourself, what am I doing wrong? Is the market bad right now? Yes. Am I chasing stocks? Am I buying stocks with poor fundamentals? Etc., etc. So what this does is this takes you out methodically and emotionlessly, during poor markets, and it gets you all in good markets. And this happens organically just by the wins and losses of your trades. And you will find with uncanny accuracy that you're on the sidelines when the market is poor, and when the market is good, you are all in. And if you're an expert, if you have 10 years under your belt and have racked a few successful years in a row, then maybe you're even on a little bit of margin. And a lot of us do what rookie trader number 1 does. When the market is easy dollar, we keep our trades at 1 grand or 5 grand or 10 grand, and we don't ratchet them up. And conversely, when the market is poor and we start losing money, we panic. We start putting on more and more size, trying to win our money back when instead, it's not like you have a 50% chance every time. When the market is poor, the odds are heavily stacked against you, and you shouldn't be putting on big trades. You should be putting on tiny trades or not at all. Now, here's a second part of the strategy. And before we get to this one, please consider liking and subscribing and or hitting the notification bell. So the first thing is that your position size is dynamic based on your performance, which will coincide for the most part with the market. All the boats rise when the market's going up. And as you know, pretty much every boat goes down when the market is poor, when the tide is going out. So the second thing is you position size based on the technical pattern. What? You don't trade off of technical patterns? If you are just a fundamental value investor, you are missing half of the boat. You got a two-legged chair, my friend. Anyway, so base your position size not only on performance of your past trades, but on the technical pattern. If you see a perfect double bottom, perfect saucer, volume is just right, the breakout is explosive, then put on whatever your full position is right now. But if you're buying early in the base at a low cheat or a cheat, then you put on a quarter and let it prove itself. And then when it builds out the cheat, you add a quarter. Then when it builds out a handle and breaks out, you buy another quarter, right? And then when it follows through, you put on your last quarter. You ease in incrementally, like you're slipping into a really, I don't know, a pool that you don't know the temperature of. So there's some other nuances too. Like, if breakouts are working all month long, then buy those breakouts when the second they break out. But if we are seeing a lot of squats, popping squats like we have been this year, then you can put on a quarter when it breaks out and then put on, a more towards the end of the day if the breakout holds up. And if it rolls over, you'll be glad you only put on a quarter. Maybe it pulls back into the pattern for a month or so and then sets up with a better handle and a breakout, and then you put on the rest of your size. I should show you that with some charts sometimes, but I'm not going to do that right now. Mark Minervini, by the way, on Private Access, he's got about 3 hours on progressive exposure. Now, here's another thing. Here's the other shoe, if you will, and that is dynamic stops. I hope you guys are using stops. If you're not, you're probably sitting on 70, 60, 90% losses right now. So, yeah, and that's why we use our stops. But many of us, me, years ago, I used a static stop. I always set my stop at 10%. I think O'Neill probably said that. When in reality, your stops are dynamic. You put it beneath support, 3 to 10%. You move it up as soon as you can. You protect that buy point as soon as you can. And your stop depends on position size. If you can put on a huge position, if you put on a really tight stop. If you put all of your account into one position with a 5% stop, that's the same as putting on 10 positions each with 5% stop. It's the same. And it's less risky. If you put on those other positions with a wider stop, you're actually risking less with that huge position. But, so yeah, big position, tiny stop, because a few percent loss on a huge position is really going to hurt you. It's really easy to think about how much money you're going to make on that, 50 grand position. But we got to think risk first. Tiny position, then you can do a full 10% stop. And then if it builds out into a better pattern, breaks out, then you can add more on and put a higher stop on that second piece. I think investors do the opposite. They put on a huge position and they say, well, I really don't want to get stopped out of this one, so I'm going to put on a 10% stop. Or I'm not going to put on a stop, but I'm going to watch it closely. Before you know it, their huge position is down 20%. And then what do? they become, oh, I'm not a trader, I'm an investor, I'll just hold this long term. You've been there, right? I've done it myself. I think I'm gonna, I think I'm gonna stop there for today. But I will tell you, so that was one of my 3 big breakthroughs where I went from being a sometimes successful investor to having consistent success. The first, like I said, well, in order, I think it was 1, using sell stops, 2, coupling technical chart patterns with fundamentals. We all learn about fundamental investing, but there's, like I said, the other 2 legs of the stool, technicals. And then the third, which, gosh, I don't know why, but I didn't learn until not too long ago, was using progressive exposure. Let me know what you think about all these ideas. What did I forget about progressive exposure? And I promise at some point when I have time, I'll get out the charts and show you, where you can add exposure. And, gosh, I didn't even say this, you can take off exposure, right? Let's say you have a 10% stop. If a stock starts behaving abnormally, if the train is not leaving the station on time, as Mark Minervini says, you can reduce exposure. You can take off a third. You can take off a half. You can do anything you want, you guys. It's your money. Thanks for watching. Give me some comments down below. Take care.